Imagine you're thinking about investing in a company, maybe one that's developing exciting new technology, or a restaurant chain that's expanding rapidly. You believe in their vision and want to be a part of their growth. When you buy shares in a company that offers limited liability, it's like putting up a financial fence around your personal savings and possessions. Think of it this way. When you become a shareholder in a company with limited liability, you are essentially becoming a part owner, but with a crucial safety net. This safety net is what we call limited liability. It means that as a shareholder, your financial responsibility for the company's debts and obligations is limited to the amount you have invested in the company's shares. This is a really important protection. To understand why this is so significant, let's consider the alternative, which is unlimited liability. Imagine if businesses operated under unlimited liability for their owners. If the company ran into serious debt or faced a major lawsuit, the owners, or in this case the shareholders, could be personally on the hook for all of it. This means your personal assets, like your house, your car, your savings account, could be at risk to pay off the company's debts. That's a pretty scary prospect, and would likely make people very hesitant to invest in businesses. Limited liability changes this whole dynamic. It separates the personal finances of the shareholders from the finances of the company itself. The company is treated as its own legal entity, a separate person in the eyes of the law. This separation is the foundation of limited liability. So if the company borrows money, signs contracts, or unfortunately faces legal trouble and owes damages, it's the company's assets that are at risk, not the personal assets of its shareholders beyond their initial investment. Let's say you invest $1 in shares of a company with limited liability. If the company does well, your shares might increase in value, and you could potentially make a profit by selling them. However, if the company unfortunately faces financial hardship, and even goes bankrupt, the most you can lose is the $1 you initially invested. Your personal assets, your home, your car, your other savings remain protected. They are not at risk to cover the company's debts. This protection is incredibly important because it encourages investment and economic growth. People are much more willing to invest their money in businesses, especially in new and innovative ventures, when they know their personal financial risk is limited. Limited liability makes investing less daunting and more accessible to a wider range of people. It allows individuals to participate in the potential success of businesses without risking their entire financial well-being if things don't go as planned. Furthermore, limited liability also makes it easier for companies to raise capital. When investors know their liability is limited, they are more likely to invest, providing companies with the funds they need to grow, innovate, and create jobs. This system is a cornerstone of modern economies, fostering entrepreneurship and allowing businesses to take calculated risks that can lead to significant advancements and benefits for society. In essence, limited liability is a fundamental concept that provides a crucial balance. It encourages investment and business growth by protecting shareholders' personal assets, while still holding companies accountable for their own actions and obligations through the company's own assets. It's a system designed to foster economic dynamism and participation, making it possible for many people to contribute to and benefit from the world of business.